The 2% rule is killing your trading account and you don't even know it. I'm Tom Alongi. I spent 30 years trading currencies for top international banks in New York, and today I'm going to show you why the most popular risk management advice in retail trading is actually designed to keep you small, keep you scared, and keep you from ever building real capital. If you've been trading for any length of time, you've heard it. If you haven't heard it once, you heard it 1,000 times before. Don't risk more than 2% on any one of your trades. Sounds safe, sounds effective, sounds professional, but what they don't tell you is that this rule was not designed for traders like you and me. It was designed for massive institutional portfolios managing hundreds of millions of dollars that had to be concerned with diversification risk. All right. So when you apply this rule to accounts like 10,000, 25,000, even $100,000, it creates a psychological trap that guarantees that you're never going to be able to scale up. Now, before we go any further, please allow me to introduce myself. I'm Tom Alongi. I've been trading currencies professionally for over 30 years. I've worked in trading rooms in major international banks in New York. I've managed institutional capital. I've been exposed to that 2% rule. I've seen what works at the professional level and what doesn't work. And I can tell you with absolute certainty, the way retail traders are taught to manage risk is fundamentally broken. It is fundamentally flawed. Let's break down exactly what the 2% rule does to your account when you are winning. You start with $10,000. The rule says you can risk 2% per trade, which is now $200. You take a trade, you win. Now you're at 10,200. The rule says you can now risk 2% of 10,200, which is $204, right? So you win again. Now you're at $10,404 and you can now risk $208. Sounds good, right? But here's the problem. You're only increasing your position size by tiny increments. After five wins, you're now risking $220 instead of $200. So that's a 10% increase in risk for a 10% increase in capital. You're scaling up so slowly that it would take you years to build any meaningful capital. The 2% rule keeps you small even when you're winning. Now let's look at the math breakdown for what happens when you're losing. You start with the 10 grand, you risk $200 per trade. After one loss, you're down to 9,800. You can only risk $196 now. After two losses, you're at 9,604. You can only risk $192 now. After three losses, you're at 9,412, and you can only risk $188 now. After five losses, which every trader experiences, you're down to $9,039, where you can only risk $181. You've lost almost 10% of your capital, but more importantly, you've lost 10% of your earning power. You're now trading with one hand tied behind your back. Do you see the asymmetry? When you win, you barely scale up. When you lose, you shrink dramatically. It's a rigged game. Because what I'm trying to show you, think in your mind, is that the 2% rule keeps you small even during success because it's slow, timid scaling. And it shrinks you rapidly during drawdowns, which is fast, painful decline. It's a psychological trap. It's not a really good place for traders to be in. And that's why I think it's like a prison. Okay. And I'm going to explain to you exactly what I mean by that. The 2% rule creates what I call the shrinking trader syndrome. You start to feel smaller with every loss. Your confidence erodes. You start second guessing your strategy, even though you spent months developing it and you know it has an edge. Because you're in a drawdown, you start to look for the other shiny objects out there. And here's the worst part. When you finally start to win back your money on a winning streak and you start building your account back, albeit slowly, you basically are damaged psychologically because you're starting to think that, wait a second, I had 3 winners in a row. The next trade's going to be a loser. I better not take that one. So you're so psychologically damaged that you can't pull the trigger on your setups, on your good setups. So you've been conditioned to think small, trade small, stay small, protect from losses. That's not how professional traders build capital. That's not how they think. You as a trader, your mindset can't be avoiding losses. Your mindset must be how to mitigate losses. Okay? You know where you got to put your stop in, and that's what you do. Okay? It's not about trying to avoid losses. Once you start doing that, you're going to be in a death spiral. Here's what really happens in the real world. In week one, you hit 3 losses in a row. Your account drops from 10,000 to 9,400. Now, the 2% rule says you can only risk $188 instead of 200. But you're frustrated, okay? You're probably a little bit angry. You feel like you need to make it back quickly. This is the worst place you could be in as a trader, frustrated, angry, and wanting your money back now. So what do you start to do? You start to decide that you're going to override your system. You're going to risk $500 on the next trade. So you put the trade on, and the trade starts moving against you. And the $500 loss is staring you in the face. And what do? Well, I'm just going to hold on to this. I know that this trade is good. I can't really afford to lose $500, but I think that I'm going to make this money back. And before you know it, you are in a catastrophic loss. Now, before I go any further, I want to make sure that you understand one major thing. There are 2 types of capital that a trader has. A trader has the capital that's in his account that is easily replaceable, and he also has what's known as what I call emotional capital. Once you start to deplete your emotional capital, it's not a good place to be. So how do you deplete your emotional capital? You basically lie to yourself. You have rules and you break them. That's one way of destroying your emotional capital. Another emotional capital, like a way to destroy your emotional capital, is that you say you're not just going to trade impulsively, and you do trade impulsively. So basically, you start slowly eroding your emotional capital when you break your trading rules over and over again. That's what causes a trader to basically go on tilt. They out of nowhere, they just start entering trades, exiting trades, entering trades, and exiting trades. And within a 10 pip range, they lost $700. When that happens, you're in a psychological hole that's very difficult to climb out of. And this is where traders blow up, not from bad trades, but from bad position sizing combined with the emotional desperation that they fall into when you break your rules. But there's definitely a better way. There's definitely a better way to do it, and I'm going to introduce you to it right now. I'm going to show you how institutional traders think about position sizing. It's a method that I used for over 30 years on Wall Street, and it's the complete opposite of what retail traders are taught. Now, I said earlier in the PowerPoint that the 2% rule is based for institutional accounts managing large portfolio that had to be worried about diversification risk. When I was on a Forex desk, it was totally different. We didn't have an institutional portfolio, it was the bank's portfolio. So we needed to come up with a way in order to trade our money and actually trade it properly. Now, there were many different money management systems that we came up with, but the fixed delta concept is the one that was really the best system that we actually developed and worked with. So it is called fixed delta, and here's the concept. Delta means unit of risk. Instead of basing your position size on your current account balance, you define a fixed dollar amount, your delta unit. Okay, the fixed dollar amount is your delta unit. And you scale your position size based on delta units earned, not on how much money you currently have in your account. You grow based on proven profitability, not arbitrary percentages. This is the fundamental shift that changes everything. And I'm going to show you exactly why it works and how it works, okay? So let's work with real numbers. You start with $10,000 in your trading account, okay? Your delta unit is $1,500, which is 15% of your starting capital. Now, I have to tell you that the smaller your delta unit is, the more aggressive you are. I suggest that you use between 15 and 20% of your starting capital. You begin trading one lot because you can with $10,000. Here's the rule. You earn delta units, then you scale up. Not when your account balance changes, not based on percentages. You scale up when you've proven you can make money, okay? If you make $1,500 in profit, one delta unit, you've earned the right to trade two lots. You make another 1,500, you move to three lots. The key difference, your position size is tied to your performance, not to your account fluctuations. This is how institutional traders think. You prove you can trade profitably at one level before you're allowed to risk more. Makes sense to you? Here's your fixed delta roadmap, the exact progression that you're going to follow, okay? You start with one lot at $10,000. You move to two lots. In order to move to two lots, you need to earn one delta unit. That's $1,500 in profit, bringing your account to $11,500. Now you're trading two lots. In order to move to three lots, okay, you need to earn three more delta units. That's $4,500 in profit, bringing your account to $16,000. Now you're trading three lots. To move to four lots, you need to earn a total of six more delta units. That's $9,000 in profit, bringing your account value up to $25,000. Do you notice what's happening? Each level requires you to prove more profitability before scaling up. You're not just doubling your risk because your account doubled. You're earning the right to trade bigger by demonstrating consistent skill at each level. This is progressive performance-based scaling. This is what the pros do. Now, let's see what happens when you start to trade some real money, serious capital. Now, at four lots, you're starting with $25,000. To move to five lots, you need to earn 10 delta units. That's 15,000 more in profit, bringing your account to $40,000. Okay? Now, at five lots, you need to earn 15 more delta units. That's 22,500 in profit, bringing your account to $62,500. And by the time you reach 10 lots, you're trading with over $82,000 in capital. Here's what's beautiful about this system. The barriers get higher as you scale up. You can't just jump from 5 lots to 10 lots because you had a lucky week. You got to earn your way through every single level by demonstrating consistent profitability. And this protects you from the biggest killer in trading, scaling up too fast before you're ready. The fixed delta system forces discipline. It forces proof. And that is exactly why it works. Let's visualize what it actually feels like to earn your first delta unit. You're trading one lot. Your goal is $1,500 in profit. Every winning trade moves you closer. Every losing trade sets you back. But here's the key. You're not changing your position size based on daily fluctuations. Okay? You're staying at one lot until you prove you can consistently make money. Watch the progress bar. This is your journey from 10,000 to 11,500. You might have some winning days, you might have some losing days, but you're locked in at one lot until you cross the finish line. No emotional overrides, no like revenge trading, no scaling up because all of a sudden you feel really confident. You earn the delta unit, then you scale. This is discipline visualized. This is how professionals think. This is delta. Now, I want you to think like an athlete, not a gambler. Imagine you're training at the gym and your goal is to bench press 225 pounds. That's a lofty goal. And you start with the 2% rule approach to your training. You start with 200 pounds. You fail a rep, so you drop to 196 pounds. You fail again, so you drop to 192 pounds. Okay? What's happening here? All right? If you fail, you know what, you're getting weaker. Okay, you're training your body to lift less weight because uh, this is the 2% rule at work, right? So it's insane. No athlete would ever train this way, but this is exactly what the 2% rule does to your training. Every time you lose, you're reducing your position size. You're training yourself to think smaller, trade smaller, win smaller. You're literally programming yourself for uh, being just mediocre. Well, who wants to be like that? Why are you going to be trained for mediocrity? Don't do that, right? Now, I'm going to tell you, this is what the fixed delta progressive overload does for you, right? Like just training. I'm using a weightlifting term here for you, where we're talking about fixed delta progressive overload. The fixed delta like equals progressive overload in weightlifting. And here's how an athlete would actually train. You start with 200 pounds, you fail a rep, you stay at 200 pounds. You don't drop the weight. You keep training at 200 until you master it. And then, and only then, do you move up to 205 pounds. Okay, you're building strength. You're proving competency at each level before advancing. This is how every professional athlete trains. This is how every professional trader scales. You don't reduce your size because you had a bad trade. You stay at your current level until you prove you can consistently win at that level. Then you earn the right to scale up. Prove profitability at each level before scaling up. This is the institutional mindset. This is the fixed delta system, okay, where you basically you scale, you stay, you scale when you win, okay? You just keep moving. You prove profitability at each level. That's how you move forward. Okay, now, how and why does it change everything? Why is there such a mental shift with the fixed delta system? The fixed delta changes everything for you because it's not just about math. It's really about psychology. If you look at the 2% rule mindset, you're shrinking after every loss. Okay? You're feeling defeated. You're basically, you know, struggling to recover. You start chasing losses. You start gambling to recover. And before you know it, you are in a death spiral. Okay? After a loss, your position size is stable with delta. Okay? You're not shrinking. You're staying composed. You're trusting the process. You're not trying to gamble your way back. You're earning your way back to the next level. And it creates a confidence spiral instead of a death spiral. One approach programs you for failure, the other programs you for success. This is the difference between retail thinking and institutional thinking. Okay? This is the difference between gambling and trading. Let's make this practical for you. How do you implement fixed delta today? 4 simple steps. Step 1, define your delta unit. I would suggest you take 15% of your starting capital. That's my suggestion. So if you have a $10,000 account, your delta unit is $1,500. Okay? Write that number down. This is your benchmark. Step 2, start with 1 lot. Trade until you earn 1 delta unit. You need to prove profitability before you earn the right to scale. No shortcuts. Step 3, scale systematically. When you've earned 3 delta units total, you move to 2 lots. When you've earned 6 delta units total, you move to 3 lots. Follow the roadmap we showed you earlier. And step 4, this is critical. Scale back safely. If you drop a rung, scale back to that delta unit size. So what do you have to do now? Here's what I want you to do right now. I've put together a complete fixed delta implementation guide that walks you through everything that we just covered: the math, the psychology, the exact scaling roadmap, the real world examples from my 30 years on Wall Street. It's free. Click the link in the description below, grab your copy, and start implementing the system today. Then subscribe to the channel because I'm releasing institutional trading strategies every week that retail traders never see. And if you have any questions about implementing fixed delta in your trading, drop them in the comments. I read every single one of them. All right. Now, I'm Tom Alongi. I spent decades in trading rooms of New York, top international banks, and I'm here to give you the strategies that actually work. Download the guide, start trading like a professional, and I'll see you in the next video. And remember, always, always, as a short-term trader, enjoy the party, but dance near the door. Cheers.